Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So majority of the companies that I own in this portfolio have reported earnings, and what I'm doing right now is just looking at them and saying, okay, should I hold on to this one? Should I sell it? Should I trim it? Should I add to it? What should I do? And that's the question I've been asking myself. And what I would like to do today is look at one of the companies that just reported, I think yesterday or day before, and see if this company is actually a still good company. Should I add to it? Should I sell it? And or should I get rid of it completely and or trim it? Whatever the case might be, that's basically what I would like to answer today in this video. If you are enjoying this type of content, please join us at the Patreon account where you get access to a lot of these things. Okay, you get access to Discord and buys and sales and the family portfolios and all of that stuff, as well as, of course, if you can't do anything else, then please like the video, subscribe to the channel so we can reach out a lot more brothers and sisters out there, inshallah. Right, so let's get started. And the company that we're going to talk about today is Intuit. Intuit is one of those companies that have had, I've got them in this portfolio and the family portfolio, just to let you guys know. And I've had them for quite some time now in this portfolio, and I feel like they haven't done absolutely nothing. A year to date, majority of the companies are up, I don't know, 20, 30, 40%, 50%. But this company has done absolutely nothing for the basically year to date. For the 1 year, it's up about 23%. So for 1 year, it's slightly up. But for the last year, basically since January the 1st up until now, has done absolutely nothing. So we want to check this company and see what's going on. So they've reported the day before yesterday, I think, or it was the day before yesterday, and the stock went down, I think, about 7 or 8% on the day. Now initially when they first reported, it was up a little bit, so I thought, okay, everything looks good, and it went up a little bit, but then after that it just went downhill. Okay, and a lot of it was because it had nothing to do with basically what you see in front of you, because this is a beat, that's a beat. They've actually done well generally overall. They were up, the different segments of their businesses has been up quite a bit, but the issue was the Q1 forecast. So when they talked, basically they did the during the call, it was something that they said about the Q1 forecast that basically predicted slightly lower, and for that reason the stock went down about 7%. And I think it's one of those situations where a lot of companies that have reported recently have not done well at all. I think the markets have already kind of anticipated, or whatever was meant to happen was already baked into the expectation was already there basically from day one. So for that reason it went down. So I want to check out today if there's anything I need to worry about on what I would like to do moving forward. So let's get started with the company. So this is one of those companies where they have a lot of cloud side of things. They've got a lot of application software that they use for different purposes. They've acquired a lot of kind of different businesses, and they kind of embedded them into one company, if you like. So they have a market and stock price right now $619 per share, EPS about just over $10, and 173 billion market cap. So it is a really huge company, and they have wide economic moat. Beta is slightly too high, okay, and current PE we're looking at almost to 60. The forward PE is almost half of that, 32. The 5-year average is 42, so it seems a bit more expensive than the 5-year average. And price to free cash flow right now is about 34, which is closer to the forward PE, if you like. The sector the IT sector right now is about 26, and the S&P 500 about 27. Now, in terms of dividend yield, 0.58. So I'm not holding this company for the dividend yield. This is one of those companies that I have in this portfolio for the growth side of things. Okay, you will get $3.60 for every share of this company that you own. The payout ratio is $21, basically 21% right now. Latest increase was 15%. The 5-year growth 15%. So this is the reason why I hold this. Very low payout ratio, which is absolutely amazing to see. Is that 0.5 hopefully will increase to at least 2% or so for the next 10 years. The latest increase, the factor was 15%, which is really nice. So that means they can hopefully, if they continue this side of things, then by the time we get to 5 to 10 years from now on, that will be a really huge number. Now, in terms of dividend streak, is about 11 years. So they've increased the dividend 11 years in a row, which is nice. Safety 98%, so nothing to worry about. Free cash flow right now over $5 billion. Free cash flow compound annual growth rate for the last 5 years is 18%, which is huge. Free cash flow yield of 3% and free cash flow margin of 29%, which is really, really good. Now, profit margin, we're looking at about 18%, operating margin of 23%, return on equity of 16%, and return on invested capital of 15%. Again, the business, in terms of the management, they do a really good job of basically taking the capital from us and the banks and so on, and they're doing a really good job with it and generating more profit for the company, which then gets reinvested into the business and so on. And they have made a total return in the last 10 years of 23%, which is absolutely huge. Now, the revenue for the last 5 years compound annual growth rate is about almost 19%, and then that growth of that is absolutely amazing, and the EPS is about 10%, which is nice. Now, current ratio, we're looking about just above 1, and that's what we got here, which is nice. Now, in the next year, they're expecting the earnings to grow about almost 15%, and then per annum they're expecting about 15%. So every single year for the next 5 years they're expecting the earnings to grow about 15%. Now, if we go back here and check out what Seeking Alpha is saying in terms of that side of things, so EPS year over year we're looking at about 14%, 15%, 15%, and that's why we're getting the average from, I think. And if you look at the revenue side of things, as you can see, about 12%, 12.5%, 12.2%, and 13%, and so on. So double digits everywhere, so which is really good. Now, according to Morningstar, they're saying it's about 13% premium, so $550 per share is where they think the price should be. Right now is $619 per share, so it has to come down quite a bit to hit that sort of a target, 13% in fact. Now, according to Simply Wall Street, okay, they're expecting the price to be over $1,000. That's 42% upside from where we are, which is again crazy. I don't know if Simply Wall Street has changed their valuations. In fact, let me just see one thing. So this is how they calculate it. Okay, so using two-stage free cash flow to equity, and they've got the discounted rate of 6.7%, perpetual growth rate of 2.5, which is basically what I've used as well. Okay, that's interesting. Risk-free rate, of course, we got that, and then you've got the formula, and then they talked about the discounted cash flow model there. But there we go. So they are predicting into the future. Okay, this is their leverage free cash flow. This is interesting. So they are using more or less the anyway. So it seems very strange, the fact that they've got it over $1,000, which is good. I hope it happens. I really hope that. Okay, but 42% are undervalued at the moment according to them. Now, according to TipRank, as you can see, for the next 12 months, they're expecting the price to be $721 per share. That's about 16% upside from where we are. Is a strong buy, which is really good to see. $708 per share, 14% from the Seeking Alpha, and it's a buy generally. I actually think I do agree with Morningstar on this one. Okay, I feel like you have to take these are very risky kind of companies, so you need a little bit of a cushion. You need that, of course, that margin of safety. So that 13%, I would say, is a good starting point. 10% or so. Okay, now in terms of business side of it, 99% business screen side of things, the debt is up very low, and the interest bearing security is 2.6. Now they have been buying back their own shares, then they started diluting it, and it's been stagnated for the last year or so. So they just left it as it was. Now, a couple of more things we need to look at, and the first one is the discounted cash flow model for this or just the valuation side of things. So we've seen 550, we've seen the 700 from Seeking Alpha, we've seen Wall Street prediction. We used a discounted cash flow model of $668 per share. That's what we got. 742 for the multiple valuations model that we used. All of that average out 750 is where we are. 620 is where it is right now. That's about 20% upside from where we are. If we say we will need a margin of safety of about 10%, 675. Okay, but this is one of those companies you just have to be careful, extra thing, and I would definitely say about 600. In fact, 600 something, it would be good. However, like I said, I genuinely think the 500s, if you can see below, if you can get this company below 600, I think that would be a good place to start. And then you start nibbling as it goes down, hopefully a bit more. If we see a market dip, then I would definitely be doing that, because otherwise it would be just a bit too much. I wouldn't be paying over 600, I think, right now. But we'll see. Anyway, so again, comparing it with some of the peers, again, I can find some companies that directly relate. This is basically what Seeking Alpha suggested. And as you can see here, for the last 5 years, if we look at 122% return, they definitely beat the S&P 500. They definitely beat SAP. The CRM or Salesforce is 72%. They beat them as well, but not as good as, of course, the ServiceNow or FICO as well, 404%, which is absolutely ridiculous. 648 for the last 10 years, 180 the S&P 500. So really better than the S&P 500. I wouldn't even worry about the rest of them. This is the most important part. And 182 for this one, 337 for this one, over 1,000% that for that one, over 2%, 2,000% for that one. But overall, the fact that they beat an S&P 500 is enough for me. Now, I'm going to share with you guys how many shares of this company I own. It's just 5 shares. When I bought it first, I was a bit cautious about it. I didn't actually buy more. And of course, my average right now is 556. Okay, or 440 pounds if you want to use in pounds. Now again, like I said, if it goes below 500, I would actually, below 600, I would start looking again, maybe buy a little bit more here and there. And I'm happy the fact that it actually has come down. And if we see a dip in the general markets, this company is quite volatile. I will potentially, that 6% it will gets wiped away. And if we can get to at least, let's just say, below 600 or 550 to 580ish, then I'll probably add a couple of more shares of this company. Anyway, that's the company that I wanted to share with you guys today. If you are enjoying this type of content, please join us at the Patreon account. It genuinely helps the channel. It keeps us going, inshallah. Have a wonderful day. Assalamu Alaikum.